Well, good morning, everybody. It looks like it is 10 o'clock right on the dot, so we'll go ahead and get started with our June 26th, 2024 WPS Medicare Audit Provider Webinar. So thank you for joining this morning. This is our 13th quarterly webinar that we've had. And for those of you that have attended these before, you'll notice that, at the beginning of each year, around February or March, we generally have one of these that focuses on the S10 audits. But then the other three each year focus on, or they really just discuss a variety of different audit topics. So this one, of course, is not the S10 one. We're going to cover a variety of audit topics. Some of them are topics that we've touched on a little bit in the past. Others are brand new ones. And we're going to talk about the agenda here. So let's get going. First of all, before we get into the agenda, though, I just wanted to mention that I will be sending out an email to all of the attendees. It'll include the PowerPoints again, in case you didn't already receive them in one of the earlier emails. It'll include an attendance certificate, the agenda again, and also a link to the YouTube recording. And once I post that to the YouTube channel, then I'll again include the link to that. This will be sent out here possibly by Friday, but it might take a little bit over the weekend to get everything done there. So you should see it hopefully at the latest by Monday there. Now, the other thing I do want to mention, and I've talked about this in the past, we have a survey for these, and this is something that CMS likes to see. So I'm going to actually post that right now. It's already included in the emails and in the PowerPoint, but I'm going to post that survey link to the chat area. You should see that right now. What we're doing with the outreach, whether we're providing it and what type of information we're giving and how people use that. So certainly one reason just from a CMS perspective, but the other reason is for our own internal use. We use that feedback to determine what we need to change about our offerings. What do we need to improve upon? What are we doing right? So if you could take a few minutes, I would certainly appreciate that. And I'll also show you the next slide. We also have a QR code for that. Now I'll show that in the next slide here. The one thing I do want to mention is that any MAC staff, so auditors or whatever that are on the call today on the webinar, this is not for MAC staff. You cannot take those surveys. This is just for providers, consultants, home offices, and those types. So it's not for Medicare administrative contract staff. So here again is the link. Now onto the agenda itself. Here we have a variety of topics. Now again, even though I said S10 is usually just once per quarter for the focused webinar, I think we have some feedback here. Let me try to mute everybody here. Hopefully that works. So yeah, S10 is for the first webinar per year is focused on S10, but we still talk about S10 in the other webinars, usually at the very beginning, just to give a very brief overview of how things are going. Now, again, some of the topics are new. Some of them I've touched on a little bit in the past. This next one here, this provider desk review / audit documentation requests. This is something I've alluded to in the past, but this is the first time we've had it ready to go. So we'll talk more about that later. It's information regarding the types of documentation requests we might be needing due to desk reviews or audits and kind of why. So we'll see that in a bit. We'll touch briefly on the audit rate and claim information pages. We've talked about that a little bit in the past, but we'll see what they look like today. And item 4 here, rural health clinics. This is something that in December, our last non-S10 webinar, we introduced the topic. We talked about a few questions that were outstanding, but we didn't really have the answers for them at the time because we had to pose that question to CMS. Now we have the answers. So we're going to talk about that again and wrap everything up. We will talk about the home office and related party costs, including the new home office form set, the electronic form set. Then we're going to talk about an overview of a few different current DISH issues, some of the projects that are going on. So we'll talk about what we can with that right now. And then now this was not on the agenda, this refresher of Transmittal 18 templates. I know we've talked about it in the past, and but we still get some questions from time to time, so I felt it was a good thing to stick in and just briefly discuss, assuming we have some time there. And then, of course, we always wrap up the discussion with an overview of our website, what articles we have out there right now, what are pending, webinars, of course, including today, and then the YouTube training resources that we have, and again, what we have kind of on the back burner for new videos coming out. Now, as far as questions, even though this is located at the end of this agenda, please feel free to type in any questions you have throughout the webinar. I have my chat area on another monitor so I can see that as we're going through the material. Sometimes it makes more sense to discuss that question while we're in that topic, so feel free to do that. So now let's move on to the first topic, which again is just a quick refresher of S10 and where we are today. So this year, course 2024, calendar year 2024, which is the S10 audit cycle is based on a calendar year. We start usually February or March of any given year, and we have to have them done by December 31st, barring any extenuating circumstances, but generally they're due by December 31st. Now this year, we're focusing on all DISH eligible hospitals, and we've been doing that for the past few years, so it's not new. But they are the ones that have the cost report period beginning between 10/1/20 and 9/30/21. So these are referred to as federal fiscal year 20. That CMS is going to use the results of this data as 1/3 of the average data that's going to be used to calculate the UCP factor 3 for the federal fiscal year 2026 rates. So the ones that will be effective 10/1/25 through 9/30/26. Now, obviously, that's a ways out. We have to finish these audits, first of all, by December 31st. CMS has to gather the data, and then they're going to use it in the proposed rule, and then eventually the final rule that'll be effective 10/1/25. So that's what's going on there. Again, just keeping with the pace of what they've done in the past few years. That's all assuming they don't decide to change course for some reason. Now, the one thing I want to mention here is when we say DISH eligible hospitals, so we're talking about hospitals that have actually reported DISH on E-Part A line 34. The thing about this, though, for the S10 audits, we are including SCH and MDH providers. This is required by CMS currently. Now, the MDH providers, that makes sense because they still have at least part of their payment that is based on the federal payment, federal rate, if you will, which includes DISH. So that part makes sense. One of the comments that a lot of people bring up is, what about a sole community hospital that has a hospital-specific rate that's higher than the federal rate? So what that would basically mean is nothing we do to the federal rate would really impact that provider because they're already paid on a higher, in some cases much higher, hospital-specific rate. And that's a good question. It's been asked over time. And if you look at the federal fiscal year 2021 IPPS final rule excerpt I have below, CMS responded to a questioner about this, and at least at that time and through this year, they basically require us to still audit the sole community hospitals, regardless of whether that hospital specific rate was higher than the federal rate. And they give a few reasons. Things could change. Certainly, they may lose sole community status for one thing, or there's a possibility that something might have happened to the rate and maybe it was adjusted, maybe it needs to be adjusted. They're 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 not common things that would happen, certainly, but that was their response. The interesting thing, though, as we'll see in just a bit, the new templates for the S10 charity care listings, the bad debt listings, and even DISH itself, DISH Medicaid Day listings. If you look at the cost reporting instructions, they have a clear statement in there that if you're a sole community hospital and your hospital specific rate is higher than your federal rate, you do not need to submit the templates upon cost report submission. So what that kind of means is it's an odd place to be that you don't have to submit the templates up front when you first submit your cost report. All the other ones you still do, bad debts, all of that. Otherwise, the cost report could be rejected. But for DISH and charity care and total bad debts, I want to clarify, basically S10 bad debts, you don't need to. But that currently doesn't mean we won't be auditing the data later on. So we may have to request that data, later on when we do that year's S10 reviews. That's, pending any changes CMS might make to the audit instructions. But currently we are required to do that. Now, the other piece of that is that you might have a provider that amends their cost report to add DISH in later on. And we still have to do the S10 audit on that in that case. So I guess even if it came in after 12/31, technically we would still have to do that S10 audit. So it's all about anybody that reported DISH. So that's what that boils down to. Now, this is the instruction excerpt I was talking about for cost report periods beginning on or after 10/1/22. If you look right here, it says if the sole community hospital is eligible to receive a DISH payment adjustment, but worksheet E Part A line 48, which is the hospital specific rate, is greater than line 47, which is the federal payment, do not complete an Exhibit 3C listing. Now, the same verbiage is found in 3B, which is charity care. 3C is total bad debts on S10. So again, you don't necessarily have to submit the documentation up front. And propose it for that matter, we're stuck with it. So now the other thing I'll mention here is that we have a variety of resources on our website and our YouTube channel regarding the S10 uncompensated care audits. So I have some links here to a variety of the training resources. But as far as our website, I do want to bring that up here really quickly just to show you a few things. First of all, our website has changed. It changed a few months ago. So if you go to this website, if you go to the old just WPSGHA.com website, it'll automatically redirect you to med.WPSGHA.com. Med for Medicare, of course. So it'll redirect you at least for the time being. But this is the look of our website. We have a search bar, which is helpful, and it works pretty well to find what you're looking for, the keyword search. You can go over here in the quick links, and for our purposes, the main thing you're going to need is the cost report audit, or you can go to Topic Center and find cost report audit there as well. So if you haven't been to this version of the website yet, it does look a little bit different. Things are aligned a little bit differently. They're organized differently. You can either look through the key issues, which you can see there's quite a few there. It tells you how many articles are underneath of it. Or if you want to see just everything and search by article itself, you just click that topics A to Z, or I'm sorry, that A to Z, and then click it again. You'll get the articles just by name. So of course, you can just do a Control F search to find a keyword in the name itself. But the one thing I want to mention, if we go back here for S10 specifically, it's down at the very bottom right now, and it's worksheet S-10. I know that throws some people off. They expect it up in just S-10. So if we go down here to worksheet S-10, you're going to see two main things. One of them is that verbiage about the charity care policies and the importance of them. The other is just the general information about the charity care audits. The one thing I do want to stress for S10 is that the audits we're doing right now are the last year under the old instructions. The new instructions come into play 10/1/22 and later. So next year we're actually going to be using those newer instructions there. So just wanted to mention that. And the website, even though that's the other thing, you are currently submitting under the newer instructions. The cost reports you're submitting right now, brand new cost reports, those are under the new instructions, but we're auditing the old instructions. So there's that little bit of a disconnect, what you're submitting versus what is being audited right now. So just kind of keep that in mind. We did talk about that in pretty great detail in our last webinar. But we have all the information here. This is what I was referring to. Just talks about the different lines, what type of data is being looked for, and all of that. Plenty of YouTube videos embedded in there. So that takes us on to our next topic, which is a little bit of a bigger one. And this is that new tool that I've been working on for quite a while. I've talked about it in the past few webinars, but we finally have it on version 1, I'll say. It's done, it's finalized. But I hesitate to say finalized with some of these tools because they're never truly finalized. We always want to improve these as much as we can. So that's why I kind of refer to this as version 1. We have a version out there. We're going to talk about it today, but we're always going to go through this and try to find better ways, better information to put into it. So these things I have on this page right here, we're actually going to talk about from the web page itself. And I'm going to go over there right now, back to the website again. Actually, go to this one. Yeah. Let's see. And again, I'm just typing WPSGHA.com. I'm still stuck on the old one. But if you go to the cost report audit section, this one, and by the way, this link was not included in the PowerPoints because it just got published yesterday. But it will be in the copy that I send out after the webinar, though. Right now, I've put it under the training link close to the bottom because it is kind of a training tool. And it's called, first of all, we have the normal training link, our audit YouTube and training resources. But this one's called the information on the desk review and audit process. So when I referred to this in the past, I think I might have referred to it as a checklist. We've been kind of going back and forth on what we really want to call it. Checklist didn't quite seem to work because it's not something we expect you to go down the list and check, yes, I've submitted this, yes, I've submitted this. It's more of a resource for things that you might need to think about when you're submitting documentation, or just things to prepare you for the types of documentation requests you might actually receive from the auditor and why. So I think if we go through this first page before I get to the document itself, this might help clarify what this is and really some of the roles of the auditors and what they really are doing, why they're asking these questions. So the first point I have here is just a background of desk reviews and audits. Now, you're required to submit a annual Medicare cost report in order to get reimbursement from Medicare. And we as MACs are required to perform some sort of final review, what we call the desk review or the audit, before we can complete a final settlement. So that is required 100% of the time. Every cost report that comes through, we're required to complete that review. But as we'll see here, the level of review varies quite a bit, depending on a variety of things that we'll talk about here in just a bit. Now, I did lay out a little brief paragraph, just a couple sentences here. It's the responsibility of the provider to prepare the accurate cost report all the way throughout. Regardless of whether something might impact reimbursement, it's still required to be accurate. And the main reason is that CMS uses that data, even the cost data, even for a PPS hospital that has no cost-based pass-throughs, they still use that cost data to set rates for the future. It helps them to develop the DRG rates and a variety of other PPS type rates. So they still expect the cost report to be accurate. And to help with that accuracy, they require MACs to audit every cost report. And it's our responsibility to provide a reasonable level of assurance to CMS that any material errors in the data have been found and corrected. So a couple of different things here. First of all, reasonable. Just like any audit, a tax return, a financial statement audit, anything, there's not going to be a guarantee that every single thing has been found. The level of cost and time it would take to do something like that, to provide 100% guarantee, assuming you could ever even reach it, is just, it's not feasible. So it's a reasonable level of assurance that any material errors in the data have been found and corrected. Now, when we think of materiality, we tend to think of reimbursement impact, and that's usually what's important. But I will say that CMS has stressed the materiality of just cost items as well. Now, what we're going to see with this tool that we're talking about in this whole page is information that we can share on that desk review and audit process. And I will say it's limited, because any auditor of any type, an IRS auditor, a financial statement auditor, one of the main rules of auditing in general is that you can't share the thresholds, the scoping tools, even the desk review or audit program steps. You can't share those with the auditee, the entity being audited. It's kind of a common sense type of thing there. So we can't share that, but I'm trying to share what we can just to give you an idea of what happens during a desk review or audit to better prepare you for the types of requests that you're going to receive. That's the overarching purpose of this tool that we've created. So as I said, the level that we perform, the level of review we perform, can range from a very quick desk review, especially for smaller facilities. These can be very quick reviews, all the way to an in-depth audit, much more in-depth, several hours for that. George, is anybody else able to hear the audio right now? Hopefully it's not complete. Okay. Okay, thanks. Let's see. Hopefully it's just an issue with maybe George's mic or headset for now. So we'll go ahead and keep going. Let's see here. So again, we're required to use audit programs and checklists that CMS develops. And again, we can't really share those, but we are required to use those. They do change from time to time, and that's one thing I want to mention. So even though we can't give details on steps, I can mention that there are new tools that we're required to use as of fairly recently. There's a new desk review that has a lot more in-depth steps. That's about the detail I can give there. Now, the other thing about that, the thresholds, those are often mandated by CMS as well in those desk reviews that they provide. Now, they may be a threshold at the entire cost report or desk review level. For example, we have things called limited versus full desk reviews. And the level of review we perform, I do want to stress this, can change from year to year. So one particular provider may have gone through a limited desk review one year, and then all of a sudden, for whatever reason, next year they might be undergoing a full-blown audit or just a full desk review. And it could be due to changes within that cost report. It could be due to new mandates from CMS, new requirements that we look at certain topics, or there is some randomness to it. And in any audit, again with an IRS audit, whatever, there's at least some extent of randomness to ensure that what we kind of refer to as the sentinel effect, that there's a chance that issues might be found and corrected. So the thresholds that we're talking about could be a flat dollar amount, just if, for example, if bad debt hits a certain amount, we might review it. Or it could be a percentage of the total amount. There might be an increase or decrease threshold for certain things. That's a pretty common one. But again, there might be issues where CMS has just found issues through their quality reviews or whatever that maybe nursing and allied health hasn't been addressed properly. They had rules that they thought were clear, but they're finding errors come through their quality reviews. So they may require us to do a more in-depth review of these topics because they haven't been correctly coming through. So that's the point I wanted to make there. And as far as the documentation, so we have this little excerpt right here, chapter 23 of the publication 15-1. It's titled Adequate Cost Data and Cost Finding. This is basically the general section that states that it's a requirement of a provider to have all that data available upon request. That's the simple way of saying that. Now, the other thing about this, as I mentioned, the scope may change from year to year, and maybe a topic didn't get scoped for review in one year, but now it is getting scoped for review. So this topic of no implicit approval, what we're basically saying here is that a particular topic might not have been reviewed, possibly for the past 5 years, and now all of us, and because it wasn't reviewed, nothing was adjusted. I mean, that makes sense. If there was no review performed, there could not have been an adjustment. So this year, the topic might have been scoped for review, and it might simply be due to the fact that we have a new desk review or a new audit program from CMS or just a new mandate from them. The same rules apply, same policy might apply, but now we're required to review it in more detail. So now all of a sudden, something that has been allowed or at least not adjusted in the past might now need to be adjusted because we're reviewing it. So the whole point about no implicit approval is that the fact that we have not adjusted something in the past shouldn't be construed as acceptance of that or approval of how it was reported. Now we're reviewing it, and it might need to be reviewed and adjusted. The other thing about that is, depending on CMS's requirements and really how pervasive the issue might seem, once we find that, there might be the requirement to reopen, the past couple of years of cost reports to see if that issue existed there as well. So even though we say final settlement, I mentioned that up above, I kind of hate that term because it's not really final until after all reopening and all appeal rights are exhausted and the timeframes are exhausted. So that's just something to keep in mind there as well. Now, consistency. And this, I think this kind of hits on Lori's question here about the understanding of the cost report and understanding the flow of the information and the training. So CMS, the overarching goal here is consistency. In a perfect world, every single MAC and every single auditor would come to the exact same conclusion when reviewing an exactly similar case. Now, that's what we strive for, certainly, and we definitely do have training. In fact, MACs are required to offer 80 hours of CET, continuing education and training, to their staff every 2-year cycle. So we generally say 40 hours per year. And part of that is cost report flow. Part of it would be the audit program steps, the desk review steps, just a variety of things. So that training is definitely there. And I will also mention that from consistency perspective, CMS and their contractor, they provide training to us as well as a group of MACs to try to strive for that consistency. But one step further, for several years now, MACs have been having what we refer to as collaboration meetings, basically to get together to discuss various issues and how best to handle them. So you can see there are a lot of things in there geared toward consistency. Now, obviously, there might be differences in slight differences in one cost report versus another, or the types of documentation we're seeing. Now, that could in and of itself lead to a different treatment. But the goal is that if it was the exact same situation, it would be handled the same way. Now, I'm not going to say that's perfect and that happens every single time. That's just something that we're striving for. So I wanted to mention that there. And of course, the other thing is the level of, if you have a brand new auditor that's just gone through their first training versus a senior that's been there for, a dozen years or so, there's obviously that level of difference. And the other thing I will mention on the note of quality, kind of jumping to quality, every single desk review that's completed is required to be secondarily reviewed by a supervisor or a lead auditor. So we have that level of review guaranteed 100% of the time. But then there's also, with each MAC, we might have managerial reviews for a sample of them. We have what we call internal quality control reviews for yet another sample. And we also have CMS QASP reviews. These are another level of quality review from an external perspective. So the goal there is to catch these issues, identify these issues, whether it be with the work paper or just how the policy was being handled, and again, try to improve that quality. So it's really an idea of continuous improvement. It's not like perfection is ever, in any area, perfection all the time is just not achievable, but you want to strive toward it. And that's really the goal there. So that is quality. And then the confidentiality piece I've already touched on. We can't share the thresholds, the steps, or the audit protocols. But this tool, the whole goal is to try to give as much information as we can without stepping over that line to prepare you for the types of documentation requests you're going to see. So that's the kind of the intro. That's the web page for it. But then here is the document we have. Now I put this, rather than just extending this web page and having all this information there, I put this in a PDF document so that we can update it from time to time. You can keep a copy of it, and it just might make more sense due to the level of information that's in there. You don't necessarily want a really, really long web page, so a separate attachment might work best. So I'm going to show you what we currently have, again with the mention that this will be updated from time to time. In fact, there were already a couple of good suggestions yesterday for updates, things we can put in here. One of them was simply a nice table of contents that you can click on the link and it takes you right to that topic rather than having to scroll down. Right now it's a 5-page document, but again, we want to put what we can to help prepare you for the documentation requests. And again, the caveat, this is not intended to be an all-inclusive list. This is just some of the big items that have come up. Some of these are due to new desk review requirements, and they may be so the first one is one of those that I'm talking about right now. The variances. I mentioned we have thresholds that are sometimes based on variances. So if you know from year to year that you have a relatively high variance, I obviously can't give the certain percentages, but if you know there have been pretty significant changes in costs, charges, days, discharges, or even cost to charge ratios, which I'll talk about in a bit. If you know there have been some variances that are maybe more than a normal inflationary type change, you may start to see requests for documentation explaining some of those variances. If they can't already be explained internally, CMS requires these, again, to help ensure that the underlying cost data is accurate. Even if it didn't directly impact reimbursement, they still want us to explain some of these things away so they can rely on that data. So that's what I'll mention there. Now, some of these are pretty straightforward. Did your cost increase above a normal inflationary amount? Again, we're not going to say, hey, you increased by $100 or $1,000, something like that. It's going to be above what might be expected. So those types of things. Now, some of those explanations, a great example recently is just the unfortunate COVID situation, the public health emergency. The years before COVID compared to the years during COVID, and then the years during COVID compared to the years after COVID, Obviously, there's going to be some of these fluctuations. Sometimes providers saw drastic increases in certain things. Sometimes they saw drastic decreases, especially things like days and discharges. That would certainly make sense. Now, cost to charge ratios. For this, for those of you that are really familiar with the cost report flow, you're already familiar with that concept. But the idea here is it shows the relationship between what you charge for a particular item, a service, and what the underlying cost was. So it essentially shows, how much profit was there, how much markup was there between cost and charge. It's actually the inverse of that number. It's a reduction factor to get you down from charge to cost. So one would expect this to be relatively consistent from year to year. So if it increases or decreases, the question is why? Was there really a change in the markup, or are things being shifted to different cost centers? Maybe the cost was moved to another cost center, but the charge stayed in this cost center. That could cause a difference, and that would probably be an unintended difference in the cost to charge ratio. Now, again, without getting too much into the weeds there of the cost report flow, these are just the types of variance requests you might see. The next one is the prior year management letter items. Now, this management letter is sent out generally when there are issues noted. Maybe they need to be adjusted that year, or maybe they're just kind of a heads up that you might need to change something going forward. So we understand that, we're in the middle of this particular desk review. It might be let's say a 12/31/22, just for an example. Today we're in 2024. So obviously we cannot expect you to have that fixed in the 2023 cost report, and maybe not even the 2024, because you're halfway through it. But the idea here is that the next available cost report that you can reasonably start addressing this issue, that's when we would expect it to be addressed. And if an issue goes unaddressed for multiple years, that's when, even if we didn't make an adjustment before, CMS would definitely expect us to start making the adjustment after the issue had been unaddressed. So that's really what we're talking about with that. That's something CMS requires us to look at. In many, many topics, it's repeated several times throughout our desk reviews. So these types of things. Another topic that's been coming up more recently is the inclusion of provider-based SNFs on the cost report. Now, obviously, that's perfectly fine in most cases, but there are certain rules from when you can report provider-based, really any provider-based unit, but they're focusing on SNFs here. And what we're talking about is, let's say you have a critical access hospital. This is where it comes up the most, because a critical access hospital is cost-based, and a SNF in that critical access hospital would be based on PPS. So there's always a concern from the CMS's perspective that a provider might accidentally, or hopefully not intentionally, but might accidentally be shifting costs from one of those units to a critical access hospital, because obviously there's reimbursement, there's cost-based reimbursement from that critical access hospital. So that's the concern. They want to make sure that if there is any unit on that critical access hospital, that it was properly approved. It belongs there, basically. So for a SNF specifically, we would need to see the approved tie-in notice, which we generally have on our side. So there might not be a question about that, but there may be a question about whether that SNF is actually located either in the main facility or on campus of that main facility, which means within 250 yards of the main building. There is an exception in some cases where CMS will approve it even outside of that range, but that has to be obviously documented as well. The other thing is there's only one SNF allowed for a hospital. So you might start to see requests for information about that, and you may never have received them before. So I just wanted to, again, prepare you for some of the questions we might have to ask. The other thing is the financial statements, audit reports, and policies. Now, for audit reports, we're assuming the financial statements were even audited. Now, for the corporate chains, of course, that would be a requirement just as a corporation. But for other types of facilities, maybe there wasn't an audit. But if there was, we would be required to request that audit report. And any policies, any financial statement footnotes that might show what accounting policies you use, we would be requesting those. And again, we may not have requested these before. This is something that CMS has expanded our review of, again, for that accuracy of cost report data. So that's why it's in this document. It's something you may not have received before, but now you may start to see it. And yeah, so we might just need some explanations on what types of policies you use for, whether it be depreciation, supply inventory, how you count, just a variety of things there. Your capitalization policies, things like that. On that same note, we have the working trial balance and the grouping schedules. Now, this is another thing where we could easily go too far into the weeds. This is more of a kind of a cost report flow type of thing, or really more cost report development. But I'm going to try to summarize this piece to say, with the financial accounting software you use, the general ledger software you use, you have your information recorded in accounts on your side. Now, you may have some managerial reports that are reported on cost reports and cost centers and a variety of things like that, profit centers, revenue centers. But the main system is based on accounts and account numbers, account names. That's perfectly fine from the accounting side. But from the Medicare cost report side, everything is reported in a cost center. So the working trial balance shows the list of all the different accounts you have, the names and labels and numbers, and obviously dollar amounts, but somehow that needs to be mapped or crosswalked into the cost center structure. That's what this grouping schedule is all about. It's just a crosswalk. It's how did those accounts translate to cost centers? Did you group account 1, 2, and 3 into cost center 1, for example? That's just a generic random example. Some of those accounts, you might have, again, multiple accounts that go into one cost center. In some cases, one particular account might need to be split out across multiple cost centers. So we need to see that grouping schedule. And that's, again, a request that outside of a critical access hospital, you might not have ever received before for an acute care hospital or anything like that. But now you may start to receive that request. It's not something the auditor is just deciding to do on their own. It's something that CMS now mandates for a lot of the reviews. Now, the other thing is that as far as this grouping, kind of an underlying requirement, or maybe overarching requirement, is that they have to be consistently grouped. Your costs and your revenues for the same basic thing should be grouped using the same logic. So we also have to review some of that to make sure everything's grouped consistently. Now we're starting to get on to the main topics here, kind of the more common audit topics that you might think of outside of just cost in general. And DISH and LIP Medicaid days. So these are two very similar topics, DISH and LIP. But some of the things we have to review, and this is a relatively recent change just in the cost reporting instructions, is that you now have the option to elect how you count the Medicaid eligible days. Do you gather them based on the date of admission, or do you gather them based on the date? And we have to be notified at least 30 days prior to the beginning of the cost reporting period. So you have to send that in and you're good to go. If you change it, of course, you have to send in a revision. But the one thing I want to mention here is that in no case can a change result in a double counting of a day. So the common example, would be if you use the date of admission in the first year, and then toward the end of that year, you had some claims that spanned over into the next year and they were discharged in the next year. If that next year you elected the date of discharge as your counting mechanism, there's obviously a risk that that same claim and all of its days would have been counted in 2 different years, which cannot happen. So whenever we see that the date of admission was used in the first year, we're looking for those things in the second year that were discharged in that year but admitted in the earlier year. And the whole claim has to be carved out of that second iteration or second instance. So that's just something we'll talk about. And that kind of goes to the discussion of a duplicate check. You might start to see questions about things that appear to be duplicates. You know, a lot of these reviews have already been done in the past, but they're more stressed, if you will. So we have to check for duplicates between prior year and current year listings if the same claim shows up twice, but also obviously within a current year listing, we don't want that same claim to show up twice there either. So there are a lot of reviews and a lot of tools we use for that, so that might lead to questions. Now, DISH, you know, this is just one of the main topics. There's obviously a lot more to DISH and LIP, and this is one area we might expand later on. Organ acquisition is a very in-depth topic, and I've only got four, I guess, four kind of subtopics for organ acquisition right now. CMS did a good job there in chapter 30, addressing a lot of those topics. So here we just have a link to it. That's all I wanted to mention in this first section. I also do want to mention, though, that kind of jumping to the very end here with our YouTube videos, this is one of the topics that I'm going to be having kind of a small series on, just organ acquisition. I don't want to have one like 3 or 4 hour YouTube. That makes no sense. So I'm going to break it up into maybe 3 or 4 different videos talking about different aspects of organ acquisition. Of course, it's a topic that doesn't impact everybody. In fact, it impacts relatively few providers. It's a somewhat rare and obscure topic, but for those that it does impact, it's obviously very important. Some big dollars can come through this, so we want to make sure everybody's aware of the requirements. So we have chapter 30, and that's just the general policy. Organ counts, I wanted to touch on a little bit because this is kind of a key thing. The ratio of Medicare to total organs is what is used to determine how much of that cost is going to be reimbursed by Medicare. So that's an important count. I don't really have a whole lot of detail here for that, other than to point you to the policy manual that covers that. And revenue for organs sold. That's another thing. The revenue that is received, whether the hospital has sold an organ to another hospital or an OPO, or if they had another primary payer that paid some of that money, that is used to offset the cost that Medicare is going to reimburse for. So that's just a comment there. Time studies. This is a topic. If you don't have an ongoing time report. Of course, if you have that, if you have a system in place for that, that's perfect. But otherwise, the time study will be needed. And Medicare bad debts, we've already had quite a bit of discussion in multiple webinars, as well as the YouTube videos and on our website about bad debt. So there's nothing really to add here. I just wanted to include it in the document with a list of different things you need to meet, or you need to make sure you meet before submitting the bad debts. Now again, I do want to stress this is right now a 5-page document. This was never intended to be an all-inclusive like training of ad debts and Oregon and Dish. That would be hundreds and hundreds of pages of training, which, we do have that type of training internally, and it is indeed hundreds of pages if you talk about all these topics. So that's absolutely not what this is intended to be. It's intended to be just some highlight. GME is another very in-depth topic for any teaching hospital. And really, there are a few things we have to focus on. Some of these we can do internally. Others we may be requesting information on. The caps, for the most part, we already have the information we need for those. We already have the base year. We already know about any sort of cap increases or decreases that were mandated by legislation. So we probably won't be asking for questions about that. But one piece we may need detail on is an affiliation agreement. That's a cap adjustment due to the fact that you're rotating residents from one facility to another. So you can share that cap if it's been approved. So the thing is, even though it might have been approved up front, it's contingent on the fact that you actually are sharing those residents. You're rotating through the different programs. So we might have questions about that on the back end if something doesn't seem to align properly. For resident amounts, we again have that information internally. It's a base year calculation that was inflated each year. But the one thing we will likely have questions on, it's the bulk of the desk review and audit for GME. It's the full-time equivalents or the interns and residents. This involves the rotation schedule, which you're virtually always going to be asked for if you haven't already submitted it. And the idea is we need to ensure where that intern or resident was rotating really all the time throughout the year. We could be talking weeks, we could be talking months, we might even be talking days in some situations where they were at different times, because we want to make sure you're getting credit for just the FTEs that you trained during that time and in the right program. That's the other thing. There might be some other issues related to new programs, or if you have residents that were displaced from another program or non-approved programs, there might be questions we ask about that. IME, I can summarize this pretty quickly. The main topic that'll come up here is the bed. We have an intern to bed ratio, which is what's used to calculate IME. The intern FTE count we've already talked about. In the GME side, yes, there are some slightly different rules, but the bed count, if we see a change from period to period, that would mean that you've either added new beds or taken them out of commission, possibly for the entire year or possibly for parts of the year, because it's an average count. The bed count is averaged throughout the year. So if we see a decrease, generally a decrease, we'd want proof on why that bed is no longer considered in service. Was it really taken out of service, or was it just temporarily not used for some reason? So there might be questions on that. Nursing and allied health is another topic we've hit on quite a bit. This is a review that's been performed quite intensively over the past few years just due to issues CMS has found. And really, I just wanted to include some notes on that here. Home office and related party costs, we're actually going to talk about this a little bit later on in another topic anyways, but here are some pieces of information. Now for settlement data for PSNR, this goes back to that grouping schedule I was talking about, but this is essentially the grouping of revenue codes from the PSNR to cost centers on the Medicare cost report. It's the same underlying idea. It's a grouping type schedule. Allocation of the PSNR. We're going to talk about RHCs a little bit later on as well. And the only one thing I will add in here, this is another topic the CMS has stressed that we review lately, and it deals with the RHC vaccines reported on M-4. The underlying rule here is that if you have a hospital patient and they're still a hospital patient at that time, if they can't get the vaccine from the RHC at that time, it won't be allowable on the RHC side of the cost report if they're still a hospital patient, inpatient or outpatient. So the requirement here is that they are obviously no longer an inpatient or outpatient at the time that they receive their vaccine administration. So for us to be able to do that review, we will be requesting now a listing or a log that supports each individual vaccine injection. At a minimum, it needs to have the patient's first and last name and either their HIC number or their MBI number, depending on the time period. And this should actually say date of service because it's an RHC. You're not going to have overnights there. So the date of service. Now, the thing is, the red flag that comes up, if we can see that this patient also was an inpatient of the hospital or outpatient of the hospital on that same date, then it's a red flag, and we might be requesting documentation for you to show that, hey, yes, they were a hospital inpatient or outpatient, but not at that time. So they were discharged, and then they went to the RHC, or maybe it was before they were even admitted. So that's something CMS has stressed to us recently. Then we had a little bit of information about the CRNA here. That we might expand that more as well. We've covered that in the December webinar too. So as I said, that's the starting point for what we have there. And before we go to break, I know I'm a few minutes past our normal break time. I just wanted to address the last question we have here about the continuing education requirements for outside agencies who do audits on WPS and CMS's behalf. And if you're talking about like some of the contractors, subcontractors, yes, that absolutely does require or does extend to them. They're required to hit that CET standard as well. And one thing I will say is that many of the subcontractors that are used, they're already CPA firms anyways. So they have their own CPE requirements, continuing professional education, that they would have to meet just to continue to be a CPA in general. So, and some of the training comes from the MAC, others comes from CMS themselves, and they might also have internal training or just training they found that they can purchase off of CPA providers, if you will. So we have that. And Tim, good question there. So you could certainly submit it with the cost report if you'd like, but it's not one of those mandated things up front. So if you didn't submit it up front, we would just request it at the time of desk review. It certainly will not be rejected if you don't submit that up front, barring any future changes by CMS. So good questions there. And let's go ahead and take a 10-minute break, and we'll come back at about 11:08, and we'll continue on to the next topic. Thanks. Okay, we're back at 11:08, so we'll go and get started again. I see a couple of questions in the chat area, so I want to address those before we move on. The first one is regarding the 250-yard requirement for SNFs and the provider-based regulation at 41365. So that's a question that actually came up quite a bit back in the day, uh, dealing with provider-based attestations for those of you that have ever had to submit one of those. And if we look at the regulation here, what it is saying is that there's not going to be a determination of provider-based status. So, for example, you won't be able to or you won't need to submit an attestation to protect your rights as a provider-based facility. And to give you some background on that, for those facilities that have a different payment as provider-based versus freestanding, which they're becoming fewer and fewer, especially the outpatient facilities, the concern is that if you have a facility as provider-based and you start billing as provider-based, and maybe that gives you more money than it would have under freestanding, if you don't meet all of the requirements of 41365 and it's found the rules for attestation, how you can attest to protect yourself from that full retroactive recoupment. If you attest and provide documentation to show that you've met all these requirements, it protects you from recoupment, at least back to the day that you submitted the attestation. So it limits the recoupment. Now, for some facilities, there's no difference in payment. Ambulatory surgical centers, CORFs, HHAs, SNFs, this whole list. So what it's basically saying is, as it says right here, the determinations of provider-based status for payment purposes are not made for these facilities. That doesn't mean the underlying criteria must not still be met. It's that no determination is going to be made one way or the other. We're not going to even accept an attestation, and there's not going to be any sort of retroactive recoupment for if you failed to meet the provider-based criteria. So this is not saying you don't ever have to meet these underlying requirements. It just means that we're not going to make a determination of all these requirements. And again, this whole list here shows facilities that don't have a different payment under the two. Now, the problem, though, even though the SNF itself isn't paid differently, in that example I gave with the critical access hospital, if the cost was shifted from the SNF to the CAW, that certainly would result in different payment from the CAW perspective. And basically what it would lead to, it wouldn't lead to a recalculating payment for the SNF itself, because again, that's PPS in both cases, it's the same amount of money, but it would lead to a termination of the SNF as a provider-based facility going forward, so that it wasn't part of the CAW anymore. So that kind of hopefully explains that 250-yard requirement there. And as far as the next question about the crosswalk, so there might be situations where the auditor asks that if you already have the MCP file from HFS that you used, they may ask you to submit that, because then all we have to do is load the new PSNR data on top of that crosswalk and then export it. And that way it'll guarantee consistency. But you're right, the crosswalk itself is the minimum requirement. So if you submitted a crosswalk, you might still receive questions if something's unclear on exactly how you're trying to map it, but you shouldn't really see you certainly shouldn't see them trying to require that, hey, I'm not going to move forward until you do this extra work. That's their work. They should be doing that on their own. But again, if you do have the MCP file and you can submit that, that would definitely facilitate a more efficient review and a more consistent review, fewer questions. But yeah, we can bring it up. We have actually a newsletter we'll be sending out to our audit staff actually by the end of this month. So I can add a discussion in there about that. to let them know, what we should and should not be asking. So thanks for the question there. And on to the next couple of topics. These are pretty quick topics. The first one that we've actually talked about a few quarters ago is this audit rate claim information page. Now I have the link to it right here, but I'm going to, I guess I'll just open up that link. Probably an easier way to get there. As soon as that comes up here. So I'm going to open that up and bring it over. This is a page. Oh, and by the way, you know what? I should just go back to audit and show you where that was found. You can obviously keyword search, but if you go down to the, so that should be the interim rates there. Yeah, the interim rate key issue or topic and the annual rate information. That's where that is found. So this will, basically the idea here is to point you to the links, make it easier to find where CMS stores this rate information for every year, and it includes every provider. It's all public information. These are PPS type rates. So we have the IPPS, the psych, IRF, SNF, all of that. We just wanted to put it in kind of a one-stop shop there. Also, we included a link to the CMS pricer, the web pricer, which is where you can find specific rates that are being used to pay that claim. So I'm sure a lot of providers already have a copy of this downloaded, because this gives you the true calculation of what you should expect when you actually submit the claim. Now, here is one note that I've been asked to remind everybody of. I might even bold it when I update the website again. When you're plugging the information into the web pricer, remember, pass-through amounts are paid completely out of the claim system. So things like bad debts, your GME, things like that, organ acquisition, they're paid outside of the claim system. They're paid through a biweekly payment. So if you're trying to reconcile what you're trying to get for that claim versus what you actually did receive, just make sure that the pass-through payments are not included. They need to be removed from that total payment in order to tie to what Medicare actually did pay. So that's a little bit of information there. There is some information on the sole community and Medicare dependent hospitals. We have some links for the SNF value-based purchasing and the quality reporting factors. And the other thing is, you can also, if you have access to the direct data entry system in FIS, you can actually find the federal rates through the DRG inquiry screen there. It's another tool outside of the pricer that you can use. And one of perhaps the more important things, so, I said annual rates are available there. They're public. They're just published every year in the Federal Register. But interim rate changes, things like Medicaid ratio, even when the SSI ratio has been revised, and just various other pass-through payments, those types of things are not found in a Federal Register. We do have to send letters out for those because we're the ones making those rate changes. But you can also, if you're unable to find that letter, or if you want to double check it, you can locate those rates in, again, that DRG inquiry screen that we just mentioned above. That's immediate. As soon as we update it, that, it's the same basic system. So it updates about as close to real time as you're going to get. Now, if you're trying to look at that pricer to find those, just be aware that that's only updated quarterly. So it's not going to include those new rates for a few months. So that we get that question from time to time. Why does pricer not include this? It's just that it's not real time. So two different things there. Now, if you ever do need to obtain another copy of the letter or any support for it, you can always contact the customer service line, or if you have an audit contact that you've dealt with for that topic before, you can submit it there. But if you do, please make sure to include a phone number and the email address. Of course, we're going to send the document through email, But if we have any questions, we might need a phone number to get back to you. Obviously, we can do that via email as well, but just for a quicker response time. I'd say out of the two, email address would be the most important. Here is information on the claims processing manual. That's where you'll find a lot of the rules. 100-04, there's a link for it, and some similar information for the OPPS side of things. The next section is something that's also kind of a living document. This is basically frequently asked questions we've had on a variety of topics. I'm not going to go through them one by one, but we'll update this as new topics become relevant, and we'll clean out stuff that's no longer relevant. So that's the audit or the annual rate information screen. I also have a link for those that have the HPSA payments. I have a link to that, and it's just simply a link to the files. This is something that's not otherwise public, so it's not in a Federal Register anywhere. So the only place you'll find it is through these links. So we have the spreadsheets that CMS gives us to share with providers. So this link takes you there. Now on to one of the other bigger topics that we had, again, because we have some questions that have been answered. This is the rural health clinic and the RHC payment. For those of you that have dealt with RHCs before, you'll be familiar with the cost per visit methodology, sometimes referred to as the all-inclusive rate. They're basically paid on a cost per visit visits you had to show what reimbursement you might potentially get. Now, the reason I have that qualifier in there is that many of the RHCs are subject to a limit, a cap. It's a per visit limit that historically it was updated annually. Now there's a change to it. It's still going to be updated, but there's a change to the methodology that we're going to talk about. Now this, before I continue on with the limit, I do want to talk about this productivity standard on M-2. So total cost divided by total visits. But there is a minimum number of visits you're expected to have for the number of FTEs you have, and that's called the productivity standard. If your total visits, your total actual visits, fell below that minimum requirement, this denominator is going to bump up to that floor. Now, if you take total costs divided by a now higher number of total visits, your cost per visit is dropping. And of course, that impacts your reimbursement. It reduces reimbursement. It's another type of cap. And I want to talk about that piece before we go any further. Here's M-2, which is where that productivity standard is reported on column 3 specifically. Physicians, the general standard is 4,200. All of the other non-physician type staff, it's 2,100. A couple things I want to mention here. This is based on a full cost reporting period, and it's not automatically prorated, unfortunately. We've asked CMS to update the software. So if you have a short or long cost reporting period, this needs to be prorated or annualized accordingly. So that's one reason this might be something while to build up a client base or a patient base, if you will. You might have had somebody retire, or maybe somebody's just now training a new person. They're about to retire, they're training somebody new. That might justify at least a temporary exception to the productivity standard. There are a variety of justifications that might come into play, but you have to submit this and be approved for it. One of the justifications that was fairly recent was due to COVID, just the fact that you might not have the same patient utilization that you did in the past, and therefore, for those years, you might have a lower number of visits, even though you have the same staff. Of course, a very classic one, the easiest one, is if you're already at the minimum number of FTEs, And this very unusual example here, and I think I just even plugged this in myself. I don't think it's real. They only have 0.18 FTEs of nurse practitioner. You can't really get below that. They're probably already below their minimum staffing requirement. So if you're already at that minimum requirement period for the state or whatever, then of course that justifies an exception. So the point is, the productivity standard, whatever you were approved for, in some cases it might just be one, basically exempting you from the entire standard for that type of professional. You put it here, and what would happen is the number of FTEs multiplied by this productivity standard gives you that minimum number. Now, the reason this is 0 is that it's a full number. It's not, doesn't allow decimals. So 0.18 times 1 is 0.18, and it's just rounding it down to 0. So there's no minimum. It's going to allow the entire 168 visits with no adjustment. So that comes back up here on M-3, where we take the costs divided by the visits to get the cost per visit. Some hospitals are exempt from a cost per visit limit, others are not. In this case, this hospital or this RHC was subject to a limit of $693, so they did not get the benefit of $919 per visit. They were subject to the $693 limit that was then multiplied by their 98 Medicare visits, just looking at this one column. Same thing would apply to the second part of the year. So that's just some background. There are exceptions. There historically have been exceptions to that cost per visit limit for provider-based or for RHCs provider-based in a hospital with fewer than 50 beds. They were able to use the full cost per visit, nothing else to review, but they were still subject to that productivity standard. There's no, other than the separate exception that we just talked about, there's no bed size exception for that. Now, there are alternative ways to be exempted from the limit. I have a link here to that. And just quickly, if I still have that up there, just want to quickly throw that out because I've had some questions on that recently. Where did I put it? Well, I guess I deleted it already. But we did, again, this website takes you there, and it goes into great detail on those alternative ways. It's pretty rare. Now let's talk about consolidation. You might have a facility, a hospital that has 5, 10, 15 RHCs in kind of unusual circumstances. The thing is, by default, every single one of those RHCs would have to have its own worksheet A cost center, its own worksheet S, which is kind of a control questionnaire for the RHC, and they'd have to have their own M series, which, as you can imagine, gets pretty tedious for a lot of those facilities. For 10 facilities, that would be a lot of extra work. Now, of course, you're still going to want all that information in great detail on your own side for just management of those clinics. You want to know how each one is doing, and you're still going to have to bill for them individually, no matter what. They still have their own provider number, but CMS does allow for consolidation on the cost report as one large RHC under one number. Again, you're still billing them separately, but everything is rolled up under one RHC. You have to elect consolidation in advance of the cost reporting period, and you have to elect if you want to remove that. It has to be done in advance of, which technically could mean 1 day in advance. It's not an approval type thing other than the timeliness of it. There's not an approval needed. It's just an election. We have to have received it. The thing is, though, first of all, this section 80.2 gives you some of the background on consolidation. And there is one important piece I do want to mention. This has changed. The location of this policy has changed. It used to be in the claims processing manual, publication 100-04. Now it is actually under the detail is under the benefits policy manual, publication 100-02. and it's Chapter 13, section, it's 80.2. In fact, let me go to our website where we have that information. I deleted it earlier. Let's see. No, that's not the one. Yeah, here we go. It's just a little bit of information. We are going to be expanding this, and that's another YouTube video that's going to be coming out pretty soon. So they reorganized the policy from Chapter 9 of Publication 100-04 to Chapter 13 of Publication 100-02. It's been a while since they did it, and they have recently revised the policy even further due to the Continuing Consolidations Act, or the Consolidating Appropriations Act. We'll talk about that here in just a bit. But this section talks about the consolidation, and that's where we had the questions the past few webinars that we were waiting on answers for. This red is the other new types of RHCs, the ones that were basically not paid. They're not grandfathered, which I'm jumping ahead a little bit, but they cannot consolidate grandfathered units with new units because they're paid under a different rate. And again, we'll see that here in just a couple seconds. So here is worksheet S-8 that you're going to see for any RHC you have. And before we get into the consolidation point, I want to show this line 12, which talks about that productivity standard. That's where you answer yes, you've received an approval. And then we already talked about M-2, where you report that new standard. So going back to consolidation, we have question 13, which has actually always existed, and a new question 13.01. Question 13 just simply says, is it all of the RHCs that were being included in that consolidation? We need to know what they were so we know which PSNRs to grab. Now, in the past, it was always all or nothing. Either all the RHCs are consolidated or none of them are consolidated. Now, with the new changes we'll see in the next few slides, there's a chance that you might have possibly 3 consolidated groups. You might have the old grandfathered units consolidated. You might have one of the new, or let me back up. You might have the new units grandfathered, or new units consolidated because they're paid on the federal rate. And you might possibly have 2 consolidated groups of grandfathered units, depending on what base year they're going to be using. We'll see that here shortly, but that's what 13.01 is all about. If you have multiple consolidation groups of RHCs, then enter yes, and you need to detail each one. Each consolidated group has to have its own S8 with the detail of what RHCs were consolidated into that one group. And again, we just need the detail. So let's get into that. We've already talked about how they have to have an A, an S-8, and all of the M-1 series, or the M series, which includes M-1, which is your kind of like your worksheet A. It's the trial balance. It details all the costs. By the way, all of this rolls up to the one line of worksheet A for that RHC. This is just the detail of it. Now, that Consolidated Appropriations Act of 2021 I referenced, this is a link to the Medlearns Matters article from CMS on that. They restructured the limits. Keep in mind, we're still saying but for the new facilities that were not grandfathered. I'll leave that at that for now, but we'll get to it in a second. Here's the new limit. They've set forth the limits all the way through 2028, and this is from Congress, by the way. So 100, 113, all the way up. I'm sure they'll extend it and inflate it later on after 2028 as well. So the point is, these rates apply to any facility, any RHC that's not grandfathered for one reason or another. So what that means is, if it's a brand new RHC established on or after 1/1/21, there's no way they could be grandfathered. That's just guaranteed to be under the new federal rates. But even if they were an old RHC established prior to 12/31/20 or prior, the only way they can be grandfathered is if they were exempt from the old limit to begin with. So they had to be associated with a hospital under 50 beds, and they still have to be associated with that hospital under 50 beds. It's one of those things where if you all of a sudden have the hospital extend above 50 beds, other than certain COVID surge exceptions, I will throw that in there. But other than that, if the hospital increases the bed count above 50, that grandfathering is gone. You can't go back and go under 50. So the RHC would then be considered kind of new, if you want to call it that. So if, again, the rate applies to all facilities other than those that were originally exempt from the 50 bed or from the cost per visit limit. So that's what this talks about. Now, I will say that the address change or an ownership change does not lose your grandfathering privileges there. And here's the Federal Register that discusses that. So the problem is, if we have these old grandfathered units, they were previously exempt from the limit altogether. That's no longer the case. They're still going to be subject to a limit. It's just not going to be the same limit that the newer facilities are subject to. They're going to have a cost per visit limit based on a base year, and it's going to be inflated forward each year. Very similar to how sole community hospitals and Medicare dependent hospitals are paid. There's a base year cost per discharge, and then it gets inflated forward every year. Similar type of idea here. So the first base year we would be using, if it's available, is a 12-year cost, 12-month cost reporting period that ends in calendar year 2020. That's the best or first base year if it exists. And we would calculate that. In fact, it's already been calculated. And we would update it to the 2021 rate, because keep in mind, none of these payment changes take place until 4/1/21. So we take the 2020 base year, update it to 2021 using this factor, and compare that to the national limit. You're never going to be harmed by being a grandfathered RHC. So if for some reason your cost was so much lower than the national rate, you're going to get the higher national rate. But otherwise, you're going to use your cost rate, and it'll be inflated every year from here on out. But let's say you did not have a calendar, a 12-month cost reporting period ending in calendar year 2020. The RHC was still in existence as of 12/31/20, but there just might one. If there is, that is now locked in as the base year. If not, it basically says continue on until you find the next 12-month cost reporting period, regardless of when it ends, and use that. And again, it'll be inflated forward for the proper years. Again, you have to stress this, that the facility in all cases must have at least existed by 12/31/20 and have been certified. They might not have provided any services, or they might not have had a 12-month cost reporting period. That's why a later base year might be used. Now, let's see what this means. And I think this will answer your question there, Tony, about you could technically have, like I said, 3 grandfathered groups, really. you could have, and I suppose more, but it'd be extremely rare to get more than that. You could have your new facilities be consolidated. They just didn't have a 12-month cost reporting period in 2020. The other ones did, but this one didn't. Maybe it got certified midway through the year, or whatever the case may be. We can throw up examples. I just looked at some earlier, but there might be 2 grandfathered groups and 1 new group. It's probably going to be fairly rare, but it's certainly possible. And that was the question that was asked of CMS. That was one of the questions. What can we do with that? Can we really have that many groups? And the answer was, to address your question, Tony, if they have different rates, they have to be, they can't be consolidated with unlike rates. That's the simple answer. So they'd have to be in their own group that have the same rate. So we'll talk about that a little bit further here. This first question is, this was proposed originally to not even allow and whoops. So a summary kind of from CMS, we asked a question: if a group of consolidated RHCs are grandfathered, their cost-based rate should be established as a consolidated group. The cost report does not provide information on an individual basis to compute a separate rate for each facility because, again, they were consolidated before the base rate came into play. The cost base rate should be established for the consolidated group as a whole. And again, we'll update that rate going forward. That's still a limit, but we're updating it going forward. We already talked about how you might have multiple groups. Unfortunately, there's an edit. It's called a serious edit, although it's not really that serious. It doesn't block anything. And it says that, hey, if you elected consolidation, then you shouldn't have any subscripts on line 15 because you technically should only have 1 RHC. Of course, that no longer applies. Now you might have 2 or even 3 lines under 15 for separate consolidated groups. CMS will need to be removing this at some point in the future. Again, it doesn't block anything right now. This one, however, is illogical. I mean, the error is correct because the situation is illogical. If you answer S8 line 13 as no, that you're not consolidated, then of course you shouldn't have any detail of the consolidation. That's what this is basically saying. It doesn't block anything, but it should be fixed. So now we're getting to the questions that we asked of CMS and the answers we got. So what if the group is not consolidated until after the base year cost report? What if they were consolidated, but then they drop consolidation after the base year cost report? Or what if just one of the RHCs was terminated that was in the consolidated group before? We asked these questions and we got an answer from CMS. The simplest, there are 2 simple things I need to stress with this. There is not to be a recalculation of the base rate when any of the group changes. And really, other than termination, which of course you can't prevent, if it terminates, it terminates. Other than that, there should not be any change to the consolidated group, period. And if for some reason there is, they're subject to the original base rate that was calculated with that consolidation group. The point is the base year is locked in and the consolidated rate, or the rate itself, is locked in once calculated. So if the RHCs were not consolidated as of the date the base rate was calculated, they can no longer be consolidated after 4/1/21. So again, everything's locked. If an RHC drops from the RHC consolidation group, again, generally this would be termination, but if for some other reason they drop, that same original consolidated rate still applies to all of those RHCs. Nothing changes. They don't recalculate the rate with the surviving group. We just said termed RHCs does not lead to a revision of that rate. And a new RHC that's added to a provider cannot consolidate with a group unless they're subject to the same national rate. Now, if it's a new RHC after 12/31/20, it can be consolidated with the new group because they all have the same national rate. They're not grandfathered. So those are the answers we received from CMS on that. One thing I do want to mention is that we're going over this information right now fairly quickly. I am going to be putting out a YouTube focused solely on this topic, and that's also going to be an update to our RHC website. So that part you'll see very soon. You'll see this website expanded quite a bit to talk about the different rates, the base rates, all of that, and it'll have a link to the YouTube video. So let's see. Yeah, here's just the different groups. We already talked about that. The next topic, which I just had a few things I wanted to talk about, is the home office cost statement. The new CMS Form 28722 for cost statements beginning on or after 10/1/22. The biggest change is these are now required to be submitted electronically, just like every provider has been for a very long time. You can send them in the same way you do any provider cost report. But they remapped them and relabeled them for the first few groups to more closely match a hospital. They're all the stuff you used to see in Schedule A, just basic information about the home office and what components it has, that's now found in this S series. And then you have A, A6, A8, and A81 that have all of your costs, reclasses, and adjustments, just like a hospital would, for example. And now the allocations of that home office cost to the various components, now it's found in Schedule B for direct assignment, C and D for functional allocation, depending on whether it's capital or non-capital, and E and E-1 for pooled. And then Schedule F is your official summary of all of those allocations. So they've cleaned up the cost statement a little bit. Now, I just wanted to briefly mention how this all links to the hospital cost report or the provider cost report. And this brings in A81 and Worksheet A. You need to understand the relationship between these two to understand that. So I'm going to start with Worksheet A first. You're going to have a lot of cost centers. Some of them have related party costs, others don't. And even within a cost center that does have related party costs, it's pretty much a guarantee that they're not all related party costs. There's probably going to be something, for example, A and G. There's probably something coming from the hospital itself, and then there's some coming from maybe a home office. But this is your starting point. This is how things were reported on your general ledger. It's column 5 of Worksheet A. This is what this column 5 of Worksheet A1 is referring to. When it says amount included in Worksheet A column 5, it's saying for this particular transaction that's in line 1 right here, out of this 3.6 million, how much of that was related to this particular related party transaction? The answer here was 2.9 million out of this 3.68 million was a related party transaction. Notice though, they also have another line 1. So it's another related party transaction that was part of that same overall number. That's another 462,000. But if you add these two things up, you can tell, yes, that's the majority of this 3.68 million, but it's not all of it. So there's apparently something else that's not a related party transaction as part of that. But out of these amounts, which by the way, we're going to need documentation, whether it be a working trial balance, a detailed working trial balance, or whatever. We'll need documentation to ensure that this is the proper number to start with. But then column 4 details how much was allowed for that transaction. Regardless of what was initially reported on your general ledger, how much was actually the cost of the related party when they provided that service to you. Now, generally, the general way you'll see that, that's usually a lower number than what was already billed to the hospital, for example, and reported here. But it could also be higher. If you can support that there's some amount of cost that was never even billed to the provider, it never made it to the general ledger, that's a situation where this number may be higher than column 5, leading to an adjustment to add more money in to that cost center. So the point is it could go either way, but we need to see documentation for both sides of that calculation or that comparison. Now down here, you'll see 4 lines that were just home office. So of course the documentation there would just likely be a home office cost statement, one or more. But up here for these types of items, these don't appear to be related to a home office. So we need whatever other documentation you have to support that. Now, the types of requests, and this goes back to that document we talked about earlier. We have some of these things laid out there. But we need clear identification of which related party related to each specific line. So back here, for example, was only one home office? So that's pretty easy. But maybe you have 2 home offices, or 1 home office and 1 regional office. We need to know which entity supports each of these costs. These lines to the list of related parties. We've suggested that CMS add that in at a crosswalk, a required crosswalk, or even extend A81 to have those related parties identified over here. They seem amenable to that change, but that'll probably be in the next form set. We need detail about what the transaction even was, and we need support for column 4 and column 5. So that's a little bit of home office. That's another topic that we have in the back burner for YouTube videos. And, we already have some website information. We're expanding that though. Now I want to move on to a topic that I will admit I was hoping we'd have final information to give on one of the pieces of this. We don't yet, but I suspect it will be coming soon. And that's the realignment piece. I'm going to So in this, with SSI, that's our main topic here, a couple different aspects of SSI. We're looking for patients that are entitled to both Medicare Part A and SSI. That is going to be divided by the total patients entitled to Medicare Part A itself. So of course the difference is, did they also qualify for SSI? And the key word there is entitled to Medicare Part A. Just to give a very, very quick summary of all the changes that have happened through legislation, Supreme Court cases, everything. The rule as it stands right now is that the patient just has to be entitled to Medicare Part A. They don't have to be paid or covered by Part A. They just have to be entitled to Part A to be counted in the SSI ratio. And there's no longer an option. So that's the rule. Yes, it's being contested. It's been contested. It's still being contested. But that is the rule, and it's been in a final rule, a recent final rule. That is currently what CMS is going off of, because it's, again, been up to the Supreme Court a couple times. They feel very, very confident of that. Now, I put some information about the Medicaid ratio, but we're not focused on that right now. Now, the difference between total, entitled versus covered, is obviously were they paid. You might have exhausted benefit patients that, yes, they're entitled, but they hit their limit, so they don't really get paid. Or you might have just non-covered services that weren't paid. Or you might have Medicare Part C days that are technically not paid under Part A, but the patient still has entitlement to Part A. So this just talks about the different time frames. Briefly, pre-10104, there was really no rule at all. But due to the Empire Supreme Court decision backing CMS's stance about entitlement being the sole criterion, that ruling 1498R3 retroactively removed this whole total versus covered election that was in this CR. However, that doesn't mean that we're going to be reopening for any cost report that was settled into that project. CMS has been clear about that. But any of those that were still open as part of that project, and you still had an election out there for covered only, that election is now null and void. And the only ones that would have been affected, for the most part, would be those that were pending realignment, which is a different topic, different reason. But those that were still open, that total versus covered election is gone. 1498 R3 retroactively reversed that. So that's the piece there. The discharges from 10104 to 93003, that's the ALINA issue that I'll briefly talk about where we are with that. We're literally right in the middle, like almost to the day, right in the middle of that project. It was yesterday, would be the middle. And this is the whole, where do the Part C days go? Again, they now go in the SSI ratio. We'll see that in another slide. 10113 and on, there's been a rule in place. It's the least contentious of all of the periods. But the point is, all time frames now follow the same rule, that regardless of whether it's an exhausted benefit, a non-covered day, a Part C day, if they were entitled to Medicare Part A, they're going to be in the SSI ratio. So this just gives you the two court cases that are relevant. And here's that piece about the 1498 R3. Here's a little meddler. Reason, by the way, we are not going back to reopen the stuff that had already been settled with a covered day election is due to this prohibition on reopening things that were changed solely due to a change of legal interpretation by a regulation, a CMS ruling, or anything like that. We've talked about this in a few webinars as well. So briefly, the ALINA Day issue. This is a project that all MACs have been working on. We're right in the middle of it. Due to that Supreme Court decision, and by the way, these are reopenings that have been reopened for about a decade now. They've been sitting out there in limbo, waiting for that Supreme Court decision and the final rule. Now that that's been issued, we can now settle those. The important thing to understand is it's the same rule that CMS was actually applying all along. It was just being challenged. So the Medicare SSI ratio already included Part C days. It has for a very long time. So those were final settled with that SSI ratio that had Part C days. And now it's the same SSI ratio. So you could argue, you could ask, why are we not just closing those reopenings? And the answer is that if we close them, there are no appeal rights. And the thing is, with the Supreme Court decision, they realized, because they remanded it back to CMS, they realized there might still be some arguments to be had, and there might still be some appeals. So CMS was required to establish appeal rights. The only way to do that is, or the main way to do that, is through a newly finalized or newly reopened settlement, revised settlement, so to speak. That's why we have to settle these instead of close them. That's why you're getting all these packages right now for very old cost reports that are zero settlements. About the only exception to the zero settlement thing would be if we looked at the SSI ratio and found that, hey, the flat out wrong ratio is used due to a mistake at final settlement. Then of course we'll correct it. We'll use the proper one. And we're talking like the wrong provider, the wrong year altogether. Has nothing to do with the Part C issue. But again, other than that, everything should be zero settlement. And let's see, the other thing, yeah, that's retroactive. So zero settlement. Now, the due date for these, which by the way, here's the link to that CR. It's public. You can see all the details we see. The due date is September 25th. And that applies to everything except for any of those that had an appeals remand. The last point I'll make about Alina is that there does not need to be a memo adjustment talking about the SSI ratio to establish appeal rights. CMS agreed with us in a meeting that there doesn't have to be any adjustment. Of course, you're going to have interim payment adjustments or maybe edit clearance adjustments, but you don't need anything else. Now, I know I'm down to the last minute. I'm probably going to go a few minutes over. For those of you that are able to continue on with me, my apologies. The realignment issue. That's the topic that is on many people's mind right now. The idea of realignment is that instead of using a federal fiscal year to gather the data, the providers have the election to grab or to have CMS calculate that based on a cost reporting period. And this is the regulation that establishes that. Here's just an example. Same provider, all these individual months are the exact same data. Option to elect that, to elect to have it realigned to your actual cost reporting period. Now, the thing is, it could be higher or lower just depending on how your ratios trended throughout the days and months. So the thing to note is once it's requested, it is indeed locked in. You can't back out of it. That's in the regulation. The other thing to note, though, and I want to stress this when the final rules do come out, talking about realignments, the thing is, realignment may not even impact your dish at all. It could hurt you. It could be lower for one thing, but it might not impact it at all. If you're already below the dish threshold of 15% and the new SSI ratio doesn't help you at all, doesn't push you above that threshold, then you're not going to see an impact to dish, so there's no reason to realign. If you're capped at your dish, certain facility types can be capped, then again, you're already capped. You can't possibly get any more dish with a higher SSI ratio. So consider those things before requesting realignment. Now, historically, and I want to stress that historically, once the MAC gets a request, we have to submit it to CMS for them to calculate the realigned SSI ratio. We do not have any of that data on our own. And even if a provider has it, which they likely do in their own internal records, we cannot use that. It has to come from CMS. Once we get the ratio, that starts the 180-day clock. Now, everything has been going smoothly for 10/1 and 13 and after federal fiscal year begins. But prior to that, we have that whole Alina Medicare Part C day issue that was in limbo. Now it's been finalized, and we're just waiting on CMS to finalize the instruction for realignment for pre-10/1/13. Again, I'm just stressing, stay tuned. As soon as we get something final from CMS, we will be publishing it on our website very quickly. And also a YouTube video will go out very quickly as well. So stay tuned for that. The Medicaid ratio, I don't really have anything new for this. We've already covered this in the past few webinars. Just have a link to the whole Section 1115 waiver day issue. And that's, again, there. The one thing I'll point out here is for the documentation templates. This applies to DISH, Medicare Bad Debt, S10. They're all found right here under our cost report section, under cost report documentation requirements and templates. And we have for everything, every topic has its own section. We have a YouTube video and an article. The other thing about this is the rules changed effective 10/1/22 and after. So we still have the old rule set for now, at least for a while, and eventually we'll remove it. But we have it broken out on or after 10/1/22. So just make sure to grab the right template if you're wanting to use our version of the template. Technically, you could build your own as long as you have the same columns and the same data elements. We strongly suggest you use ours. It's just simple on both sides, but it's up to you. It just has to have the same data elements. We have instructions in there and everything. And now we're to the kind of the wrap-up stage of the webinar. What I have right here is just a link to our website itself, the audit section, link to our YouTube audit playlist, which again, we're going to see a few more out there the next month or two. And the next few slides are just lists of all the YouTube videos we have currently up till today. And here are just a few that are planned. I've talked about a few of these already, RHC and organ acquisition. I am going to also put a YouTube video out talking about that document that we went through early on. And home office is the one thing that's not included in this list yet, but it's on the back burner. Just a list of our webinars. And I want to go to the questions here before I wrap everything up. So let's see. Is there a way that communications regarding rates, tentative settlements, all of that could be sent to providers via the secured email system? So the thing about that is we do have what's called a paperless NPR approval, and some of this is in flux right now. We're trying to move to a more electronic communication system, but the part that's unfortunate about it is that with that paperless NPR system we have right now, we are required, or at least we are currently required, to confirm that we have the absolute most proper email address before that stuff goes out, because we're required for those NPR packages, especially the NPR packages, that we have to make sure they go to the facility at a minimum. And if not, then one could argue, is that even a valid NPR, official NPR? So we have to make sure one way or the other we meet that requirement. So when we do the paperless process, part of our current process is to go through a confirmation stage. We send out an email saying, hey, is this an email address that links to the facility? Is this the proper contact? Is it still current? A lot of times we don't get emails back, so we have to wait another week or two and follow up again. So all of those follow-ups take a lot of time, and in the end, we might still have to send it out via hard copy. Again, there's a pretty short time frame where that has to be issued. So that's the concern, and that's something we're working on with CMS. We can send a copy of some of that stuff to home offices and other facilities. And really, if you ask your auditor that's working with you about that, they can send you a duplicate copy of it, essentially. So that's kind of where we are with that at this point. We have been talking about that internally, trying to find ways to streamline it, though. And let's see. Yeah, so Matt, good question about the sole community hospitals. If they are paid on the hospital-specific payment, so that's higher than the federal rate, I wouldn't say they're exempt from using those exhibits. They're just not required to submit it at the time of acceptability. So DISH and Charity Care specifically, they're just not required to send that in. We might still need it at the time of audit, like the DISH and Charity Care again, but you're not required to submit it up front. So hopefully that helps to clarify. Oh, and yeah, Brian, that is a good point there. That's another thing that's come up in our discussions. The MECRF system, if we sent that stuff out, if we loaded it there, then you may very well find a lot of that information there, the NPR especially. So it just depends on who in your system has access to that. But that's a good way to find it as well. And that honestly be the quickest way because it's loaded there before it would ever make it in the mail or anything like that. So with that, thank you for sticking with me for an extra